Hey, it's Kathy here, and today we're going to look at what are securities, and more specifically, debt and equities. So let's just get started with the basic definition of securities. They are a financial investment with some monetary value. It entitles the holder to ownership of a part of a publicly traded company, for example, a stock or a bond. They are listed on the stock exchange, so they can be bought, sold, or traded on the secondary stock exchange, on the secondary market. Which I didn't finish that sentence, but it's supposed to say market. Yeah, so they're basically a stock or a bond. That's what securities are. And the two types of securities I'm going to focus on for this presentation, because this is just the basics, the beginning, like what are securities, is debt and equity. There are many more, and I'll link to a website in the description where you can read about more types of securities if you so choose to. So securities are either categories into a debt or equity, and debt securities are bonds, and equity securities are stocks. So let's look at debt securities. As I just said, they are known as bonds. So when a company or government entity wants to borrow money, it can either get a loan from a bank or issue a bond. And since loans are difficult to obtain, bonds are often used to secure finances. A company issues a debt security called a bond, and when investors buy bonds, they are basically lending the company money. And once the bond matures, investors get their money back with interest. So that's how investors make money. They get their money back plus interest. So they make the interest money from that bond. So for example, a school district wants to build a new school. They issue a bond and raise money to fund the project. Investors who buy the bond lend money to the school district while expecting to get paid their money back with interest. So what are equity securities? They are shares of a publicly traded company stock. They offer a way for companies to grow beyond securing private funds. When a company declares an initial public offering or an IPO, it starts selling stock to the on the open market. Stocks represent shares of ownership for the investor. So if I buy a stock, I'm buying a little tiny piece of that company. The company that can raise capital to grow the business, So a company would issue a stock in order to raise capital to grow the business or repay debt obligations. And as an investor, you make money by buying the stock and selling it at a higher price or through dividends. And dividends are a way for the company to share profits with investors. So what is the effect of securities on the economy? Well, they are a way for investors to make money by lending them to companies and governments. So by lending your money to the government and via a bond, you're making your money back with interest, so you make money there. And by lending them to companies, you buy the shares or the stock at a lower price and sell at a higher price, making money as well. By buying a share or a bond, an investor is voting for that company's future growth. Yes, you're expecting to get your money back, so you want to be investing in a stock or a bond that you think will be successful. Securities inject money into the economy, helping both the investor and the issuer. And on the flip side, there's always a flip side, right? It's not all good news. They can also cause the stock market to fluctuate and sometimes wildly, so it can be unpredictable. So the pros of owning securities. They're a good hedge over inflation in the long run. They takes advantage of economy growth. They're easy to buy and sell, and they provide many ways to make money, from dividend stocks to bonds. So dividends and interest. The cons of owning securities is you could possibly lose your entire investment if you buy securities in a company that is unsuccessful and goes bankrupt and loses their money. They are subject to stock market ups and downs, and they require a lot of research. For a beginner like me, I kind of rely on Motley Fool Stock Advisor because they do a lot of the research and pass on that information to you, so you can make the best decision based on their research, but it kind of weeds out any companies that may not be right for your portfolio or just a bad investment in general. And on the flip side, they also recommend investments. So if you have a certain amount of money, they say like maybe invest it in this stock or this stock. Just kind of helps you with doing the research, because that can be very overwhelming in the beginning, like it is for me. So I rely on the Motley Fool Stock Advisor quite heavily for my picks of stocks to invest in. So the bottom line for securities: do not risk more than you can afford to lose. Okay, if you can't afford your money to be tied up for like 10 plus years or 5 plus years, don't invest in stocks or in securities. It is a long game, and you're investing in your future and for your retirement. Don't expect to get it back out in like 6 months. It's not really what the stock market is for. It's for playing the long game. And also, for more information, you can visit wealthsimple.com, this website here, and I'll link to that in the description also. So thanks for watching. I hope that kind of cleared up what securities are, or at least made it, if you're a beginner, at least now you understand when you listen to people talking about securities, what they're actually talking about, which is basically a stock or a bond invested in a company. So yeah, thanks for watching and listening. Please leave any comments and questions down below, and I'll do my best to answer them. And if not, I will definitely point you in the right direction. And as always, stay positive, work hard, and wash your hands.